Welcome back. You're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, the S&P 500 shows no sign of flagging. So we spoke about these incredibly resilient US markets last week. Although I think there are some concerns that the long bond yields are flattening out, and this could be a potential warning sign, but it's not reflecting in the equity markets just yet.
No, not yet. Look, there are warning signs. There's plenty of warning signs out there, but you're right that none of them are really reflecting into the equity market as yet. At some stage, I'm pretty sure that these things will come home to roost, and the markets will probably start to adjust accordingly. But if we look at the S&P 500 just as it is right now, and I mean that's always what you've got to work with as a trader and as an investor, I suppose, as well. Look at what you've got. Look at what's presented in front of you right now. As I see it right now, there's the chart of the S&P 500 in front of us. For the moment, it's still looking okay. The big break was above that 2,400 resistance back in late May, actually. And you can see that the market has been grinding higher ever since then. And right now, we seem to be in the midst of an upward sloping channel over there that you can see quite clearly indicated, which joins the highs and lows quite neatly on that chart. So the bottom of that channel at the moment comes in at about 24.30, and the upper boundary of that channel comes in somewhere at around about 24.70 or thereabouts. So for the moment, it's still grinding higher. There are a few things to just be a little bit wary of. There's a little bit of negative divergence evident on this RSI at the top here, which does sometimes suggest that the upward momentum might be slowing, but that can sometimes last for a while before things start to correct. So for my money right now, I can't really say that there's anything particularly wrong here. It still looks like it's likely to continue grinding higher. If it breaks to the bottom side of that channel, well, then we change our mind. But it hasn't happened yet, and we'll wait. When it does, we change our minds. Earlier this year, you implemented an option structure against a possible correction in the S&P 500, which never bore out. Yeah.
Is it something that you would consider maybe for the latter part of the year?
Yeah, it is something I definitely consider. I have been thinking about it, and I think that possibly for the August to October timeframe, it's possibly when I might look to put some sort of possibly a put spread structure onto the S&P 500 to take advantage of any potential downside, but without having to pay away too much. And as you know, and as the viewers will know, I mean, we've certainly got to do something on that offshore portfolio of ours because it's lagging badly. So I do need to pull a rabbit out of the hat there. And possibly something like that for the latter part of this year might well be in order.
And just maybe one last comment, is it also maybe too late to go long, just a naked long position?
Look, if I was going to go long here, I would look for a reversal up off that 24.30 level, off the bottom of that channel. And provided we get a reversal from there, then I would look to potentially buy it with the stop loss below the reversal low. Looking for a bit of a move to the upside, but not aggressively. I wouldn't be buying this market aggressively, certainly not. Just something else on an aside. I mean, I read a very interesting note this weekend which talked about the fact that we've now entered an era of quantitative tightening in terms of the Fed, where they're looking to try and shrink the Fed's balance sheet. And if you go back many years now, or the last sort of 5 to 7 years, let's say, we've had quantitative easing in the US, and that has been market stimulative. Now we're getting quantitative tightening. Theoretically, that should have the reverse effect. And admittedly, the Fed is going about it in a very careful way. They've talked about $10 billion a month worth of bond sales, which is nothing like what the purchases of $80 billion a month that they were doing during quantitative easing. But the point is that you would think that the reverse probably does apply now, because we're no longer in that stimulative quantitative easing environment. We're in a quantitative tightening environment now. And that's something to be conscious of, I think, looking forward.
Yeah, I mean, it'll be very interesting to see how it plays out on our own market, which is just a very, very frustrating place to trade, I think, at the moment.
Yeah, it is. I mean, I'm sure many out there share the sentiment that I do. It's an incredibly difficult market to trade. Everyone that I speak to in the game is saying how tough it is, and it's not getting any follow-through on movements in the market. It is difficult, and particularly if you look back over the last 10 days. I mean, now this is the graph of the top 40 future that we've got in front of us here. And you can see if we go back to sort of the second week of June here, this market is the same level now as it was 10 days ago, and it's just been chopping up and down, up and down. You can see red candle, green candle, red candle, green candle, up, down, up, down, up, down, no particular direction really. For what I'm seeing here is that we've got a possible, I think it might manifest itself as a bear flag that is potentially forming here. We could maybe still push up to 46,000 on this future, where there's quite a bit of resistance from previous swing lows and swing highs at 46,000. If we were to start to get a reversal down from that level, then I think that might give more credence to my argument of a bear flag. And quite feasibly, you could see that breaking out the bottom and maybe going and taking out those recent lows that we saw there. But then what I would start to look for is the potential for some positive divergence on the RSI at the bottom here as a possible buy signal for a bit of an oversold bounce. And I think a lot of people have been looking for this oversold bounce, and it's not coming. And what concerns me about that is that the market is loaded up with long positions now, expecting the bounce. If it doesn't come and we do start to falter and move to the downside, then you could find there's a whole bunch of stale longs trying to get out. And that could give us the move to the downside, which I suspect might be the case here.
I mean, you would profit from it as a result of the option structure that you have, but what about those two all-me contracts that you took out? Would that then be a little bit problematic if there were to be a bit of a if you flushed all those stale bulls out of the market?
Not really. Remember that the option structure that we've got is on one all-Z future, and it's a put spread. So effectively, we've got a bearish structure working on 10 Rand per point on the top 40. Two all-me futures is 2 Rand per point. So effectively, I'm long 20% of what I'm short. If that makes any sense.
Yeah.
The bottom line is the payoff of that option structure with the all-me futures is illustrated on the right of the diagram here. So you can see that green area is our profitable zone on our option structure with the all-me's included. So we only run into trouble below 42,700 down here. Anywhere above 42,700 now we're going to make money. And at 46,000 is where we would make our maximum profit. But do keep in mind that this structure runs out to the September futures closeout, which is still nearly 3 months away. So there's a lot of time to wait, and we do need to just be patient on this thing. But I'm still fairly confident that we're actually well positioned here, and I'm inclined not to want to fiddle with it too much because I quite like where we are and how we position with this thing right now.
Although I have to say, heaven forbid, we just do nothing for the next 3 months because we'll just want to pack up and really retire our market boots.
Well, yeah, absolutely. But I must say, in my history, I've always found the middle months of the year are a little bit like that. They're difficult, they're choppy, there's no particular trend. And if I look back in my trading journals over the years, I've always found the middle months of the year when I struggle the most. And it's got to do with the northern hemisphere summer when there's less activity in those markets. And it translates into us here. But I've often thought, why bother
Why
trading?
am I doing this?
Why bother trading those months? Actually, just wait for the easier months of the year, which are generally the 6 months from October until March of each year, March, April.
Yeah. Having said that, though, Garth, what you want to do this week is look at the 5 biggest stocks in the JSE, and you do seem to be somewhat concerned about the potential for a break downwards.
I am a little bit concerned, and I think it also talks to what I was mentioning about that bear flag structure on the all-Z future there that we spoke about. So I'm going to look at the 5 largest stocks that make up the top 40, because these 5 stocks collectively make up around about 46% of the weighting of the top 40 index. So if you can get a good indication of what you think these stocks are likely to do, then you can get a pretty good idea of what the top 40 is likely to do. So let's have a look. Naspers obviously is the real big boy. And I've shown this chart a number of times, particularly towards the end of May, where I said that Naspers has been trading in this large upward sloping channel over the last 2 years or so. And you can see that the price reversed down perfectly off this 2,850 area back at the end of May, and it started to come lower. Now, you can see Naspers does this from time to time. It goes into these lengthy consolidation periods that can last 3 or 4 months at a time. Look back in early 2016, and then in late 2016 it happened again. And my suspicion is that we've entered one of these periods again on Naspers. So I think, be patient with this one. It probably still could come lower. If I zoom in a little bit on the chart and look at the more recent trading action in Naspers, what I'm seeing here is, I think, possibly a bear flag or a rising wedge type of structure. There was a little gap in the chart formed in the first week of June over there, and that gap has now been filled, and we've had a reversal down from that level. So if this channel or this bear flag type of thing starts to break below 2,600 Rand, then I think that opens potential for another leg to the downside. And a move to 2,400 or 2,450 won't surprise me too much here.
What about the other 4? So starting off with Richemont, which to some extent was the sleeper stock of 2017.
Yes.
But it's sort of wobbled of late?
It has wobbled a little bit of late. When it started to wobble was when it put out some numbers in early May, which missed the market's expectations, and you can see that the share price has gradually been dribbling lower ever since then, after that gap to the downside there. There's what I see as a possible head and shoulders beginning to form here. There's a little rising wedge where the recent move to the underside of the 50-day moving average has now resulted in some selling pressure. There's been a reversal down from that level. And now from here, it doesn't surprise me if we go back to this 103 Rand area where the neckline of that head and shoulder structure is. And also do keep in mind there's a little gap in the chart at 102.29, and I think that could possibly be targeted. And if we start to go meaningfully below that level, then I don't think it's unreasonable to expect to move down to 100 Rand or even to 98 Rand, where the 200-day moving average comes into play.
Yeah. BHP Billiton, I mean, today actually it was having a decent day, but that chart just doesn't look great, does it?
No, it doesn't. You know, all these resource shares to me actually look pretty sick at the moment. Look at this BHP Billiton chart. It's just a consistent pattern of lower highs over here. It doesn't look very fantastic. I also look at these charts in London, Billiton, Anglo's, Glencore, the Rio Tinto and the like in London. They're all looking rather weak and soggy. And I think that if we start to see Billiton below 185 Rand, then it probably sees this share going sub 180. That doesn't excite me at all, that chart.
And then British American Tobacco and MTN?
Yeah, so British American Tobacco, here you go. That also to me looks like a potential head and shoulders structure forming over here. I think we're in the throes of forming a right shoulder here right now. The neckline is at 870 Rand. I think there's a fair chance we go down to 870 Rand, and then let's see what happens from there. And then MTN, it broke below 117 Rand in early June. It went very quickly down to the next support at 110. It's now making a counter trend bounce up to 117 again. My suspicion is that if it fails there and starts to turn lower, then we might be moving back down to 110. Again, not a particularly bullish looking chart setup to me.
Now, this would all be quite different, I think, if the Rand was suddenly to collapse in a heap, but you are in the camp rather that sees the Rand going stronger from this point.
Yeah, I think I am. All of these shares that we've spoken about are very currency sensitive, so they are at the mercy of the Rand to a large extent. This is a chart of the Rand-dollar exchange rate at the moment, and what's evident here is that we are in this also kind of a channel pattern with the Rand-dollar exchange rate. You can see it reversed down from the underneath of the 50-day moving average last week, and the Rand seems to have moved stronger over the last couple of days. When I look at this and I just eyeball it and I look at the negative reverse divergence on the stochastic there, I don't think there's any reason why this thing is not going to 12 Rand 50, unless there is some political noise which suddenly changes things. If the Rand were to weaken significantly all of a sudden, well then you can take everything I've said and chuck it out the window. But my thesis is that the Rand probably moves a bit stronger from here, which will continue to weigh on those shares that I've spoken about.
So then very quickly to wrap up, Garth, the portfolio's constant from last week.
Consistent. There's our South African portfolio. We do still have our Sibanye Gold position open, which is not doing very much for us. We'll maybe revisit that in next week's show. We are up 22% for the year to date on the local portfolio, taking into account the theoretical profit on our option structure. Offshore, it's not looking so good. We're still down 4.8% there, and I really do need to get something happening on that portfolio before the end of the year.
Indeed. And then, as always, you can get a weekly alert by subscribing for a weekly email on your website. Garth, I have to leave it there. Thanks so much for joining us this evening.
Thank you.
Garth McKenzie is founder and editor of Traders Corner.